Good morning. Welcome to the i3 webinar on sustainability in emerging markets, co-hosted with Stewart Investors. Now, from the onset, I must say there's been quite some misunderstanding and possibly misinformation about sustainability in emerging markets. Hence, we thought it might be useful to focus a bit more on that confusion or sustainability myth, if you will, at this session. In other words, we might attempt to do some myth busting here. I'm Tech 10 from i3, and joining me today is Jack Nelson, a portfolio manager at Stewart Investors. Jack joined the team at Stewart Investors in September of 2011, and is now the lead manager of the Global Emerging Markets Sustainability Strategy. Welcome, Jack.
Thanks, Ty. Good morning.
Now, the emerging markets asset class is extremely varied. It includes democracies and dictatorships, economies reliant on manufacturing, and those that export commodities. And more importantly, some of the very best companies in the world alongside, well, some of the very worst. In addition, there seems to be a consensus that sustainability investing in emerging markets is significantly more difficult as compared to the developed markets. Now, is that true? Some of the problems we often hear, and there's no disclosure or maybe hardly any disclosure in emerging markets. The developed markets companies are well ahead of their EM peers when thinking about sustainability, and engagement, well, it's just too hard. So in the next 40 minutes or so, we'll attempt to examine how valid some of these arguments are and whether there's a counterpoint to the prevailing consensus. Now, this will be a fireside chat between myself and Jack rather than a presentation. Now, where appropriate, I know Jack has a couple of slides and charts just to illustrate some of the points. Now, I'll encourage the audience to submit the questions via the question box anytime, and we'll endeavor to answer them in the course of the conversation. Now, this webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. Now, Jack, let's get started with perhaps start busting some of this myths. So, really, the notion that sustainability investing is really more difficult in emerging markets. Why does people think about that? What makes people think that sustainable investing and emerging markets are sort of at odds, or they don't go hand in hand, or it just doesn't exist?
Yeah, I think at a very high level, when people hear the term emerging markets, they immediately think of things like, well, the idea of the BRICS, the Brazil, Russia, India, China as the four big sort of headline countries, or they think of what they know of as the large index constituents over time. And some of the largest companies in the emerging markets universe have been concentrated in industries like oil and gas or mining, and in countries like Russia, where you've had certainly environmental and governance challenges in the past. And so I think for some people, emerging markets has become a bit of a byword for either corruption or environmental degradation. And just to use a slide just to quickly illustrate, I think what most people tend to think of and illustrate some of the challenges I think we operate in. I mean, this idea of the contradiction is pertinent, and it's because people feel, I think, when they hear the idea of investing in China, they think, oh, isn't China the country with the terrible air pollution, factories belching out smog, and isn't India the country where you have this terrible plastic pollution alongside all the social issues it has? Is emerging markets not the asset class where you have all the deforestation in Indonesia and Brazil? And is it not the place where you have these mining disasters which can sweep away whole villages? And the answer to all of that is yes. And to our mind, rather than making investing in emerging markets with a sustainability mindset more difficult, it makes it imperative. It means that if you are to allocate to emerging markets, having that framework of thinking about sustainable development is hugely important. And it's highly plausible, as we have done, to run an emerging markets portfolio successfully whilst avoiding companies involved in many of these issues, indeed investing into companies that are providing solutions. So people think of, the top 10 of the asset class, the big mining companies, the big state-owned groups. But in fact, there are 20,000 companies in emerging markets, and for a portfolio, you only need to find 40 or 50. As you said in the introduction, you have some of the very best and some of the very worst companies in emerging markets. So I do think it's a bit of a myth that it's impossible to invest sustainably in emerging markets. And in fact, it's probably more important, I'd argue, in this asset class than in others.
Yeah, thanks. I think to your point, there's this prevailing perception that investing in EM means investing in fossil fuel-heavy industries. There's also the notion that the developing world should be allowed to get rich first, say industrialize, then worry about getting green. And implicitly, there's that somewhat trade-off between human development, which includes poverty alleviation, and environmental protection. Now, before we get down into it, perhaps let's get back to fundamental and say, hey, how do we define sustainability? How do you define sustainability? Now, we know it's about climate change, but it's more than that. What's sustainability?
Yeah.
How do you define it?
It is. I think sustainability is a really simple concept, which the investment industry, amongst others, has embellished and complicated probably more than we needed to. We've come up with a lot of alphabet soups of acronyms, but in truth, I think most of us intuitively understand what sustainability is. And ultimately, to us, it means delivering a high level of human development within resource constraints. So it's about everybody in society having enough, and that being sustainable through time by not degrading the environment and the ecological services we rely on to provide that high standard of living. So again, just to use a quick slide, and it's the last one, so won't spend too much time on it, but it's the chart we've used for a long time to define sustainability, to answer this question. So we've lifted this from the Global Footprint Network, who combine on this chart two measures on the X and Y axis. On the horizontal, you have the UN's Human Development Index, which is a proxy for human development. It includes life expectancy, literacy, and income rates. And it's a very imperfect measure, but it's probably the least bad one that's widely available and has data, going back a long time. It shows, as you can see, as societies become richer, as their citizens become more educated and have access to greater healthcare outcomes, they move left to right. And that's fantastic. And that's been the high level story of human development over the last 30 years in emerging markets, is hundreds of millions of people being lifted out of poverty, which is obviously a fantastic thing. And we are living through, I'd argue, a one-off leap in living standards globally as countries the size of China and India go through this process. But what that doesn't capture, what the Human Development Index neglects to include, is how is that human development being delivered? What are the environmental costs? Are we doing that within our budget constraints? And that's what's on the vertical axis. So this ecological footprint per capita is a broad measure of land, water, air, food resources, and so on. And that dotted horizontal line is the Earth's carrying capacity per person. So essentially, every society on the chart, which is north of that horizontal line, is consuming more resources than is sustainable in the long term, and every society below it is consuming less. Now, as you can see, that bottom right quadrant of minimum global sustainability, where you have high levels of human development within resource constraints, has proven very elusive, and most countries tend to overshoot on their environmental impact as they deliver those high human development outcomes. So this is what sustainability is to us. This is what sustainable development means. And ultimately, in an investment context, what it means is that we're trying to invest in companies which are contributing to and benefiting from the countries they operate in, moving towards that bottom right quadrant. So that could be companies which are developing solutions which provide better healthcare outcomes and therefore contribute to human development, or it could be clean technologies which help societies move from north to south on the diagram. But ultimately, this is a good framework for us. It helps us map back to make sure we're keeping in mind when we're investing and looking at meeting companies in emerging markets, do they fit what we're trying to do? Is, are they contributing to moving towards that bottom right quadrant of minimum global sustainability?
Yeah, I think this is a really interesting chart because we talk about that trade-off between human development and environmental protection, and I guess the way you define your universe in a very narrow sense, that green box. And while what we see on this chart are countries, obviously you're a fundamental stock picker, so I guess you're looking for companies that fit that very narrow universe, if you like.
Yeah, and I think the idea of this trade-off is a really important point, and it only exists in the short term. So you can go and find a company bottom up which might be delivering healthcare outcomes, or maybe more pertinently, let's say housing outcomes. A cement company, let's say, providing materials for essential infrastructure and housing in the emerging world. that clearly would have a role on that diagram in moving society left to right in terms of providing housing. But if that's powered by coal-fired energy and carbon-intensive fossil fuels, then ultimately it's not helping move towards that bottom right quadrant on the diagram on the vertical axis. And I think the key point here is that trade-off exists in the short term. Yes, we can go and say, well, let's go and build lots and lots of coal-fired power and lift people out of poverty in a narrow sense. But the trade-off dissipates the longer out you look. So if you were to say, okay, let's go and do that today, what happens to those people who we move into those housing units in 10, 20, 30 years when maybe those people are experiencing sea level rises, greater storm surges, more intense tropical cyclones, et cetera, and those buildings we may construct with that cement may not be viable anymore. And so there's this idea that the trade-off between the environment and human development exists in the short term, but in the long term, the environment will ultimately win. If we lift people out of poverty today, only to send them back into poverty in 20 years because the ecological systems that they depend on fall apart, then that is not a good outcome. So I think the point, our perspective is that emerging markets today unfairly don't have the option of following the same development path that the rich world did in centuries gone by. They ultimately, if they're going to deliver that high human development, it will have to be within resource constraints because it's simply not viable on a long-term perspective to deliver high human development in countries like India without degrading the environment to the point that those human development outcomes will fall apart sooner or later.
Yeah, I get a sense. So you're saying emerging market companies have to follow a different path of development, unlike their developed world counterparts in the past. Can you give examples of that?
Yeah, absolutely. I mean, we see in emerging markets the trade-off on the front line all the time, and I think it's evident that emerging markets today are not only the places where many of the issues around broadly sustainability will be determined, as in whether we have X meters of sea level rise will in no small part be determined in China and India. But more than that, it's also people in emerging markets who will be bearing the brunt of the challenges. And if you think of almost any social or environmental issue, soil degradation, desertification, inequality and access to opportunity of people of different backgrounds and genders, all of those are intense problems in the developed world, but they're only more intense in the emerging world. And so when we look at stocks, we see that manifesting itself bottom up. Quick example, I remember doing reports on dairy companies in South Asia, so in Pakistan, for instance, and if you looked at a broker's sell-side report, they'd have milk consumption increasing ad infinitum at 10% a year. And then you step back and you think, well, what are the climatic constraints on that in Pakistan? It's a country which relies on annual snowfall melt to irrigate the fields and to feed the cattle and to produce the milk. Their aquifers are being pumped and will not be there forever. The Himalaya will not provide the same level of runoff in future. And so the sort of DCF of the broker just runs up against reality quite quickly. And you see that happening more and more. We've visited dairies in Inner Mongolia in China, and again, same issue. You have this rising demand, but you don't have the supply able to meet it because the Gobi Desert gets closer and closer to those cattle herds every year. So a good way of trying to solve that problem and find a company which can, I guess, meet the demand within resource constraints is a company probably many listeners will be familiar with, which is Vitasoy, which is actually a Hong Kong-based company, a family business, which we've invested in since the mid-1990s. And Vitasoy is well positioned for solving these challenges and for helping provide high development outcomes in terms of nutrition within resource constraints because of the simple fact that providing plant-based food and milk is massively more efficient in terms of water and land and carbon than dairy milk. So, if you fast forward 20, 30 years and you look at the dairy industry, which today already has greater emissions than aviation and shipping put together, and you think, where will we be if everybody in Asia wants to consume beef and milk like the Argentinians or the Swiss? The answer is we won't have a planet left. So companies like Vitasoy have a huge benefit because they will have the tailwind of the demand, and they won't be having to worry about, is our supply chain going to exist in 20 years because of the environmental challenges faced.
That's really interesting. I think these examples do to sort of add a lot of color to the discussion here. Now, one of the, I guess, if you like, pet peeve of most, when you talk EM, is about ESG scoring. Now, I'm not going to labor too much into some of the inconsistency and difficulties with rating agencies. I think we're well aware of that. But I happened to look at one of the reports you did, and if I could quote a comment, you said, one of the main challenges is that ESG scoring methodologies tend to focus on how well companies manage their internal process or processes, rather than real world impacts of their products and services. I guess it inward versus outward looking. Can you explain the differences here and how you perceive them?
Yeah, definitely. So I think, look, ESG scoring methods have come about from a good place. They're an attempted antidote to greenwashing, and it's only right that clients or prospective clients get to see what's in the funds and understand. I think scoring misses a lot, and one aspect of what it misses is this idea of, what you score is so arbitrary that you get very different outcomes and very little correlation between the outcomes that this different providers come up with. And companies have become very good at jumping through the hoops. They've become good at disclosure, integrated annual reports, ticking the boxes, mapping to the SDGs, and achieving high scores from the ratings agencies, and then ending up in sustainable funds. And to our mind, sometimes that somewhat misses the point. Sometimes not everything that matters can be measured, and not everything that can be measured actually matters. Some basic examples to our mind would be things like the fact that PepsiCo scores as AA and very high marks on many of these scoring systems, because they'll have diverse boards, they'll have lots of disclosure around waste and very efficient operations internally in terms of things like water use and so on. But ultimately, the products and services they're providing, if you go back to that diagram of high human development within resource constraints, what is their contribution to the world? How are they helping society move towards that bottom right? And the answer obviously is they're not really. The products that they produce tend to contribute to poorer health outcomes and therefore move societies from right to left, the direction we don't want to be going. And if you contrasted that with many emerging markets companies that we think fundamentally in terms of what they do are very well positioned, a company which scores far worse than PepsiCo, I think BB, is Brazil's biggest pharmacy chain, which we've owned for many years, which ultimately is about consolidating a very fragmented and inefficient drug distribution system, making it more effective, bringing down costs, and getting access to medicines more widely dispersed throughout Brazilian society. And in some ways, it's almost the exact opposite of what PepsiCo is doing. And rather than contributing to poor health outcomes, this is contributing to fundamentally better ones. But maybe because they haven't got the same disclosures, maybe because they haven't jumped through the same hoops or mapped to the SDGs in the same way, they get scored at a lower level. So to our mind, those ratings approaches do miss a lot, and we don't use them ourselves in terms of constructing portfolios. We far prefer to look at the fundamentals and do that proprietary research in terms of fitting companies into the framework we discussed. And hopefully, over time, there'll be less misunderstanding from clients or potential clients about what the ratings actually mean, because they don't necessarily capture, I think, what people sometimes think they do.
Yeah, I think an example I can think of is, I guess, the tobacco industry, which there are companies that have done well on, I guess, the Dow Jones Sustainability Index and others. In the same line as what you've said.
Yeah, they've done well because they tick all the governance boxes, and they're very good at reaching out to their supply chain and the communities which are involved in the agricultural side. And it's not to say that's not a positive. It is, but I don't think that's what people expect to find in a fund labeled sustainability at the end of the day. They ultimately, I think, understand sustainability in the intuitive and much more fundamental way that we talked about earlier, which is contributing to superior outcomes. And so we have to be quite careful about making sure we don't become over-reliant on some of these ways of metricating. I think the investment industry is probably guilty of over-metrification. We're as a group of people prone to trying to force everything into numbers and rankings and scores, and sometimes they just vastly miss the point. I remember an example from India where we were looking at a company where they appointed a new independent director, a female director who had some strong credentials, but perhaps the reason she was appointed was that she was the wife of a junior finance minister in the Modi government. And in an emerging markets context, sometimes you see companies doing that, and it's not too difficult to work out why that person's been appointed. And if you were to sort of score that in a top-down way, you probably would get a big tick for diversity, which is, again, not a bad thing, it's a good thing, but it would miss the context and it would miss the richness of whether that's a positive or a negative. And I think ultimately we just feel you can't boil down many of these issues. You can't put integrity into a spreadsheet. You can't boil down the ethics into a scoring system. And so have to be careful about relying on them too much.
Yeah, I like to draw this because it gets a lot more complicated in emerging markets. But taking a step back, I happen to obviously agree with you on whether is it PepsiCo with sugar or tobacco or sort of perceived corruption, if you like. But I just wonder, look, you've got the quantitative metrics, for all the weaknesses that rating agencies have, they serve a purpose. And you overlay with somewhat, if you like, subjective, your analysis, but could be subjective. Is there a risk of going to what some would call values versus value investing, when it becomes a bit more subjective, and how do you then determine a bit more concrete around these things?
Yeah, I think the truth is that everybody has different values. So I think it's probably very difficult, if not impossible, to completely separate out values from your approach to investing. Even if your value set is, I only want returns, I don't care. That is in itself a value judgment. So I'm not sure it's a very clear dichotomy. But you're right. It's very difficult for people to agree on the definitions. What's sustainable to me might feel unsustainable to you, or vice versa. And I think the only way around this is radical transparency. So what we've done at Stewart Investors is we've created a world map on our website, with every company we own on the world map. And anybody can go onto the website and look at every company we own, what they do, why we own them, what the risks are, what the engagement priorities are. And ultimately, hopefully that helps people judge, is what Stewart Investors means by sustainability what I consider sustainability to mean. And you won't find fossil fuel companies, you won't find tobacco companies, you won't find sugary drinks companies. If that chimes with your understanding of what sustainable development is, then you'd agree with us. But we would equally find many alternative views out there, and there's not necessarily a right and wrong. There's many different paths up the mountain and different values that people can put in place. So probably no one correct answer with that, but I think the only way of making sure that people don't feel they've been misled is radical transparency, is making sure people know exactly what's in the product and in the fund.
Fair enough. And drawing that into, I guess, the whole disclosure discussion, and maybe this is a myth here for you to answer. So there is this common notion that developed market companies are well ahead of their emerging market peers when thinking about sustainability. But you're saying that in many cases, potentially the opposite is true. You've also used the word, say emerging markets are often at the coalface of sustainability, and you've used the word design for sustainability. Can you explain what you mean by that?
Yeah, sure. So I think there's a few aspects to this. In terms of disclosure, the data side of things, I suspect you would find that emerging markets companies in aggregate are behind developed markets companies. There's been less pressure from investors, particularly domestic investors, I think, in emerging markets countries to disclose many of the data points that we'd like to see. And so foreign investors like ourselves do have a key role to play there in pushing for more data, so that some of these analyses can become more robust over time. But I think it almost is a reflection at a high level of the different development paths that countries have taken. If you were to look at today's rich countries, which have become as developed as they are through relying on fossil fuels, through a linear consumption model, through a sort of take, make, and throw away type approach to consumption. Because that is having to be leapfrogged in emerging markets. You see companies which have evolved in that context and that environment, which mean they're sometimes further ahead in terms of the actual fundamentals of what they do. So, you know, if you were to step back and say, Brazil has one of the most sustainable electricity mixes in the world. It's quite reliant on hydro, given its large sort of river resources, and also has quite a large penetration of solar and wind as well. So it's gone quite far in moving away from fossil fuels. It's in contrast, if you were to say, okay, where is Australia? We clearly have to. We've built our energy system on one approach, and we're now having to change it. So, and countries like Brazil, and hopefully also others in emerging markets, will have the ability to learn from mistakes and to take a different path in advance. And that has led to some companies growing up in emerging markets, which have now become globally competitive in those areas closely connected with those sustainability issues. So, for instance, in Brazil, there's a company called WEG, which we've invested in for many years, which is one of the world's most advanced producers of electrical equipment, motors, generators, transmission equipment, and it's particularly got a strong market share and specialty in renewables. So because they have been producing equipment for Brazil's domestic energy grid for decades, for hydro, wind, and solar, they're now globally competitive with ABB, Siemens, GE, and now have more than half of their sales are outside of Brazil, and they're setting up factories in China and Mexico and taking the expertise they've developed in Brazil and taking that globally. And I think it's a good example of how, when we say design for sustainability, it's really about, because these companies have grown up in the context of acute sustainability challenges, and in some cases, societies which have leapfrogged, they sometimes are very well placed. And that gives us lots of opportunities to find those great companies in emerging markets.
Sure. Well, I guess the issue also comes down to disclosure, where there are companies that do well on disclosure. There are still inherent biases in ESG scoring, and that's why it sometimes led to the notion that there is no disclosure, or there's very little disclosure, and also this other notion that developed market companies tend to score better because some of these other EM companies, sometimes smaller, sometimes lacking resources or even language, don't produce those very lengthy reports, and they get penalized, I guess, for that.
Yeah, they do, and I think it again comes back to what actually matters here. Is it what can be measured, or is it the fundamentals? So one area that is quite close to our hearts in terms of thinking about what makes a good company and a sustainable company is the idea of stewardship. So, to our minds, sometimes the best setup for a board of directors can be not necessarily to have 100% independent directors. If you were to look at scoring systems and what governance looks like in developed markets, that would often be seen as best practice. Wholly independent board and a separation of executive and board direction functions, and that's very much just in the context of the ownership structures we have in developed markets. And emerging markets are very different. So if you were to go and look at many companies in emerging markets, there's usually a controlling shareholder. You're usually as a minority, putting your faith in the hands of a government or a family business, a family who control the business, and they often control the board. And that can be a good and a bad thing. It means as a minority investor, you can be more vulnerable to abuse. But at the same time, when you find some of those large stakeholders, often families that have long-term time horizons, family businesses often by definition have passed the business on through several generations and are seeking to do so in future. And that naturally aligns many mindsets with sustainability. So to our mind, often, there's no one size fits all for what good governance is. Sometimes the best decisions are made in the context of long-term ownership structures, which in a developed market context might be seen as poor governance. But it's very much contextual. I think in emerging markets, it's different.
Yeah, I think the comment you made caught my attention, and talk about that sometimes there's no need for a fully independent board. Now, obviously, you get a big tick in developed world. What you are saying is that it depends. You can argue both ways. I'd like to pick up your comment on family-owned businesses, particularly in emerging markets. And obviously, again, there could be both ways where minority shareholders, now you may or may not have a voice, but From my understanding, in family-owned businesses, and I would say this is probably regardless of whether they are EM or DM, they do suffer from the complexity of emotional ties, entitlement, talent management, succession, and the like. And then you throw in cultural nuances, depending on which country. Like in Asia, there's multiple issues there. How can you tell a difference between what's good business and otherwise?
Yeah, it's a key issue, and it's certainly not the case that every family business is well run, or has good governance. I mean, some of the worst businesses from a governance perspective are owned by families. So it does give you the space to either be sometimes abused as a minority investor or looked after very, very well by a long-term steward. So it's a very broad range. The idea around nepotism is one we do encounter on a regular basis in emerging markets. You see family-owned businesses, and maybe they're in the third generation, and the family are still involved in running the company day to day. And it's not always, it's never clear cut to say this is positive or negative. I think it's very much you have to analyze the individuals and try and get to know them and meet them over time. But certainly there is a risk with that approach. There's a risk, this idea that the first generation creates the wealth, the second generation preserves it, and the third generation tends to lose it. It's not a phrase that we hear for no reason. It has some truth to it. So I think what often we try and look for, and it's not true in every case, obviously, but what can be a very powerful combination is a family-owned business where maybe the matriarch or patriarch of the family might sit as the chairperson, and their role really is to make sure that culture of stewardship persists. The balance sheet doesn't get over leveraged. They don't make silly capital allocation decisions. They don't tarnish the reputation and name of the company. But day-to-day management in the hands of, hired professionals who are aligned on a long-term time frame and overseen by someone with a multi-decade time frame. It can be a very powerful combination, because then you get, the stewardship aspect of someone who is ultimately very concerned about reputation and the 10 and 20-year view with someone who's got the capability, the experience, and the credentials to run things day to day in an efficient way. And that's often a powerful combination we look for.
Yeah, I think that's a very interesting point, and I guess probably a contrast to when you think about development market, large company CEOs with 3-year or 5-year tenure with short-term bonuses. Again, that could be a good or bad thing as well, depending on how you see it. So there are both sides to this argument.
Yeah, of course, and it comes with pros and cons. You don't really want to go too far to one extreme or the other. You don't want to be too sleepy or too ruthless, maybe. But we love the idea that when we go and meet some of our companies in India, they could be 100 years old or 150 years old, and often the person in the chairperson role will have inherited the business from his or her grandparents and very much be of the mindset that his or her job really is to make sure that it gets passed on for another 3 generations. And it naturally aligns you on sustainability. When what you have really is your reputation built up over generations, you're not naturally inclined to abusing your workforce or polluting the environment or cutting corners in the accounts, because you're in it for the long haul. It's very different from someone, as you say, who has an EPS target to hit to realize your options package, where the incentives are very different. Then you might cut some of those corners to make sure you have that outcome.
Yeah, this is a good segue to go into engagement, because it relates to family businesses engagement. But if I might just pause, because there is a question from the audience here, which relates to some of the discussions on disclosure and scoring. So if I might read out to you. So without using some of the scoring system, how do you demonstrate that the non-financial characteristics, so stuff we're talking about, of the portfolio are consistent with your stated objectives? Or do you leave it to your clients to judge it?
Yeah, so we try and use a combination of quantification where we feel the data is robust enough. So if you were to look at, for instance, carbon emissions, I think that's probably one area where we feel there is robust enough and widespread enough data from company disclosures to give to quote that figure. So our portfolios are on average 90% less carbon intensive than their respective benchmarks around the world, and that's a function of not owning companies in many of these high risk industries. And we feel comfortable using that figure and that data point. We would feel less comfortable maybe using some others where companies don't disclose, and then you end up with third parties trying to guess or estimate the numbers, and often we look at them and we don't feel the numbers are very robust. So we try and use some data where we feel it's relevant, and then we try and use some more non-financial data as well. So in our presentations, we'll talk about the fact that we don't own any state-owned companies, but we do have a large portion of the portfolio invested in family businesses, and make that contrast. And it's a non-financial way of quantifying where the portfolio sits with regards to some of these ideas. We also try and map the companies in the portfolio to a few different schemes. So if you were to go onto our website and look at that world map, for each company, you'll see what we've tried to do is to map the company to, firstly on the environmental side, to a set of solutions called Project Drawdown. Project Drawdown is a science-based collation of the most powerful mitigation technologies and solutions around climate change. And so if you were to go and look at VEG, for instance, on our website, it would be mapped to the drawdown solutions for industrial scale PV and for hydro and for those sorts of solutions. On the human development side, we've developed our own proprietary framework, which has 10 human development pillars. And again, on the website, you'll see us map Vitasoy to nutrition and VEG to access to energy and these sorts of things. So we've tried to describe what we're doing using our own methods, I think, rather than other people's, just because we feel if we're going to have to try and do that, we'll try and do it on our own terms and just try and be as transparent as possible, knowing that it won't necessarily suit everyone's framework if they are relying on scoring methods, but we'd rather keep the robustness of what we're saying rather than rely too much on data we don't really necessarily feel is that reliable.
Sure. And I'd like to again jump into the engagement discussion. In the earlier remarks, I said, well, we know engagement is difficult, but following on from your point where you say, lots of emerging market companies, you've got either government-owned or majority government-owned or family businesses. I'm just thinking, oh my goodness, this is too difficult. How do you define engagement in emerging markets? What does that mean?
Yeah, I think engagement is a key part of being an active manager, in the sense that your job isn't finished when you buy the shares. Our job is to be active, not activists, owners, and ultimately where we feel our role is to say that markets in general are quite short term. Portfolio turnover is quite high. Managers of companies are very conscious of the need to hit their quarterly targets and deliver for the short term. And in that context, it can be quite difficult for the managers and owners of businesses to step back and have the space to address long-term challenges. And I think where we have the credibility of being long-term shareholders, and our average holding period is relatively long. And as we've mentioned with some of the examples, Vitasoy we've held for nearly 30 years, VEG we'd have held for at least 15. We can talk to those companies as credible long-term shareholders and say, we've been invested for this long. We want to continue to stay invested for many years and decades. Please feel that you have the space to address these issues. And we're not going to sell the shares tomorrow if you have a poor set of quarterly results because it's to fix a long-term issue. So maybe to give some color or make it tangible. One issue we had in India, coming back to that very first slide, those images of plastic pollution. We've invested for many years in many of India's leading consumer companies, and many of them will sell things like soap or shampoo or toothpaste to consumers very much at the bottom of the pyramid. And those consumers never have the cash flow to buy, a $10 bottle of shampoo. Their cash flow profile is very small and regular. And so you have to sell to those consumers in very small plastic sachets, so the size of a ketchup sachet. And it's been a fantastic innovation. It's meant the companies have been able to grow sales in those rural and bottom of the pyramid populations. And those people in turn have had access to these hygiene products. And we would consider that, again, as contributing to society's move from left to right and towards high human development. The challenge, obviously, is when you produce billions upon billions of plastic sachets and you don't have the recycling infrastructure or the collection infrastructure in place, they end up in the water system, in the soil and so on. And you can see that when you walk around cities in India. So we were able to say to those companies that we'd invested in for a long time that eventually the government will have to address this. Eventually they will have to say to you, you have to stop selling in plastic sachets, change the composition of the material or become responsible for collecting it. And that's going to be a risk. It's going to be an earnings risk to you at some point in the next 10 years. So rather than wait for that to happen, let's get ahead of it. It's not something which matters over the next 2 quarters, agreed. But over the next 2 decades, it very much does. And we've owned Unicorn shares for 20 years. We'd like to continue to. And we managed to bring together around a dozen companies in India at a round table with some NGOs, some universities from Australia. And on the back of that, the Indian Plastics Pact was launched, which is helping the companies move towards 100% post-consumer waste collection, and it's helping them mitigate the risk. So for us, engagement this example is illustrative of a few things. It's linked to risk and return. We do it because we think it helps make the companies better and lower risk over time. It's done in a collaborative way rather than wagging a finger and being activists. And it's done with a view to providing that long-term space to address issues.
Yeah, I suppose the long-term nature does diffuse some of the, if you like, the difficult short-term tensions. I'm sure you have difficult situations, and again, like I said, to my comments about Asia, you throw in the cultural norms where often societies there are non-confrontational, yet how do you push across a particular agenda? And that's
it is different. Look, I think it's just part of being an emerging markets investor. It is different from going into an Australian or American or British sort of executive and saying, listen, mate, this is what we want to do. This is what you should be doing. It's very much more about building relationships with people, being credible as a long-term partner for the company and for the people, and then making sure we keep humility in mind. You know, none of us as investors have run businesses, and we're talking to people who've built and run multi-billion-dollar enterprises. So having that humility to offer a perspective, stick to your principles, but at the same time, be patient with your engagement. Don't expect it to change tomorrow. Make sure you have in mind you have to earn the right to engage, and that you have to knock on the door over maybe 3 or 5 years before people take it seriously. And if you're investing alongside stewards who are also long-term minded, they will often be receptive to the idea. You just have to make sure you don't approach it in the way you would approach it in Australia or in other countries where the culture is very different.
Yeah. A couple of questions I'd like to quickly address it before we run out of time. And this relates to state-controlled companies, and questions, why no state-controlled companies? And to preface that, if you don't like the credentials of the government of a country, then presumably it's a higher hurdle to like a company that's domiciled in the particular country. Yeah,
that's true. I think no SOEs has been in the portfolio for a while, and it's simply because for many years, and it's a simple reason that ultimately the objectives of those companies are different from ours. Our goal is to make clients as much money as possible over the long term, incorporating sustainability, and their objectives are to support whatever the government's objectives of the day are. And a key lesson for us over time has been not to go down the quality curve. I mean, we talk about quality a lot in our investment philosophy, and you could have at any time in the last decade bought a company like Gazprom on a very low price to earnings multiple. But you'd have been doing that knowing that it's really a tool of the Russian state rather than a company, or at least you should have understood that. And so obviously we never owned it. Last company we haven't invested in Russia for many years, and it comes to that point on the credentials of the government. Absolutely, you need space in a country, in a society, for private markets to be an attractive investment destination. And in Russia, for instance, the last company that we owned there, the private entrepreneur who had founded the business was essentially forced to sell it to the government, and it's now controlled by a group linked to somebody who married the foreign minister's daughter. So you can see how the family connections have led this person to be a multi-billionaire, and that's how Russia has worked for a long time. And we haven't had any money there for many years. We have nothing in Saudi Arabia for a similar reason. It's very difficult to find companies there that are sufficiently distant from the government. And obviously the elephant in the room is China, and China is difficult. We do have holdings in China, but they are in industries where we think they are sufficiently distant from the government. Smaller companies, not the commanding heights, and certainly not state-owned companies in China, where it's very difficult to invest without having a view on the government's priorities, which is obviously very difficult to know in advance.
Cool. Look, just have time perhaps for a final question to round up. We've had this session, we haven't talked about returns, so maybe a final question on returns. So in the current macroeconomic environment, which is not easy, has there been a trade-off in returns four sustainability factors? And how do you do the balancing act?
Yeah, look, I think if you zoom out over the long term, our mission at Stewart Investors is to prove that there is not that trade-off. There is no, in the textbook, you would be told that if you eliminate part of the investment universe, your returns are going to suffer.
Yes.
And our argument is that's wrong. If the companies that you're removing from your sort of universe are the state-owned Russian oil and gas companies, or any other myriad of the 20,000 companies in emerging markets where you're prone to governance abuse, where you have headwinds from sugar taxes, where you have headwinds from fossil fuel consumption falling over the next 20 years. By eliminating those companies from your universe, you're not diminishing your returns, you're improving them. You're focusing on the companies which have the best quality credentials and the best sustainability credentials. So the funds, generally speaking, have performed well over the long term. And we think that's been built on that combination of making sure we focus on quality of fundamentals, but also on the sustainability tailwinds. So to our mind, and our mission is to prove that there is no trade-off, and we passionately believe that actually you can invest sustainably and have fantastic long-term returns as well as an investor. In fact, they go hand in hand.
And on that very interesting counterpoint, that's all the time we have. Hopefully for our audience, we've clarified some of the misunderstanding and maybe busting some of this myth in the process. I hope this has been meaningful. Thank you very much to Jack, Nelson, and the team at Stewart Investors for sharing your views and research. And hopefully we'll have another discussion another time. Thank you, and bye for now.